All right, let's dive into a really big question that's on a lot of people's minds, especially when the market starts getting a little wild. Is moving your hard-earned retirement savings into a super safe money market account a smart move? I mean, on the surface, it seems like a no-brainer for protection, but as you'll see, there's a lot more going on under the hood.
So let's just get right to the point. Can you do it? The short answer is yes, absolutely you can. But the real question, the one we're going to unpack together, is should you? Is it actually the right decision for your long-term financial future? And you know, it makes perfect sense why this is such a hot topic. Protecting your principal, that nest egg you've spent decades building, is priority number one for anyone getting close to or already in retirement. So let's figure this out and see if this safety-first approach really does what you need it to do.
So there are basically three main ways you can go about moving your retirement funds into a money market account. We're going to walk through each one step by step so you can see exactly how they work and, more importantly, what the pros and cons are for each.
Okay, so here are the options on the table. First, you can roll your funds into a money market IRA. Second, you could reallocate the money inside your current 401k. And third, the most extreme option is just cashing the whole thing out. Let's start with the one you'll see most often.
So this first way, and it's a really common one, is doing a direct rollover. What you're doing is taking the money from, say, an old 401k and moving it into an IRA, an individual retirement account. And once that money lands in the new IRA, you simply invest it in a money market fund.
So the good news is it's a nice, clean transfer. You don't get hit with any taxes or penalties, and your principal is safe. Plus, it's pretty easy to move that money into something else down the road. But, and this is a big but, the downside is huge. The interest rates you'll get are incredibly low. That means inflation is probably chipping away at your spending power.
So here's the bottom line. This strategy is best thought of as a temporary parking spot for your cash. Maybe you're just waiting for the market to calm down for a few months. It is definitely not, and I mean really not, for someone who needs their money to grow over the next 10, 20, or even 30 years to pay for a comfortable retirement.
All right, our second method is even easier. Instead of rolling your money out of your plan, you just shift it around inside your existing 401k. Almost every plan out there has a super conservative choice, like a money market fund or something called a stable value fund, that you can move your balance into.
The best thing about this? It's super convenient. There's no paperwork, no taxes, and boom, your money is instantly protected from those wild market swings. The trade-off? Well, you're limited to the few choices your company's plan offers, and you might be paying some administrative fees. And just like the IRA, the returns are going to be low and will almost certainly lose the race against inflation.
So who is this really for? Well, it mostly makes sense for people who are still on the job and just want to dial down the risk for a little while without all the fuss of a rollover. It's definitely not the best choice for retirees who really want full control and access to a much wider world of investment and income options.
Okay, now for option number 3, and I've got to warn you, this one is by far the most extreme. Cashing out your retirement account completely. This means you pull every penny out, take the massive tax hit, and then put whatever is left into a personal money market account. This is a whole different ballgame.
And let's be super clear about the immediate danger here. If you're under 59 and a half, the IRS is going to hit you with a 10% penalty right off the top, and that's before you pay income tax on the entire withdrawal. You could literally watch a third or more of your life savings vanish overnight.
When you look at the pros and cons here, it's not even a fair fight. The only, and I mean only, pro is that you have the cash in your hand, no strings attached. But the cons are devastating. A giant tax bill, those harsh penalties, and you completely lose all future tax-deferred growth on that money, forever.
So, I want to be crystal clear on this. This is not a retirement strategy. This is a break glass in case of emergency move for someone in a truly desperate financial situation. If your goal is to have a secure and comfortable retirement, this is almost never, ever the right call.
Okay, so this brings us to a really critical point. We've talked about how you can move your money to a safe place, but now we need to talk about the hidden risk of leaving it there too long. Why is that temporary parking spot such a terrible permanent home for your nest egg? And this quote right here, it just hits the nail on the head. The very thing that feels so safe about a money market account in the short term, its stability and low returns, is exactly what makes it so risky over the long term. So think about it. Your money is sitting there, safe and sound, maybe earning 1.5%. But if inflation, the rising cost of everything from gas to groceries is chugging along at 3%, you are actually losing buying power every single day. Your safe money is silently getting weaker.
So if being too safe is actually a risk, then what's the answer? How can you protect your principal from those scary market drops and set yourself up with an income that you can't outlive? That is the million-dollar question for retirement, and thankfully there are solutions designed to do just that.
Okay, so let's talk about a powerful alternative called a fixed indexed annuity. It's often paired with a really important feature called a guaranteed lifetime withdrawal benefit, or GLWB for short. Now, this is an insurance product built from the ground up for retirement security.
Let's put this head-to-head with the money market idea. Now, both of them protect your principal, which is awesome, but that's where the similarities end. An annuity gives you the potential for higher growth by linking your returns to a market index, but without the risk of actually losing money in a downturn. And most importantly, it can do something a money market could never do, give you a guaranteed paycheck for the rest of your life.
And this is the real game changer. With an annuity, you can lock in a guaranteed payout rate for life, often somewhere between 5 and 8% of your account value. That income is locked in. It's guaranteed. It doesn't matter if the market crashes. It's like creating your own personal pension plan.
So when you boil it all down, it comes to this. A money market is a tool for parking your money short-term. But retirement isn't short-term. The real goal isn't just to keep your money safe from losses. It's to grow it wisely and turn it into a guaranteed retirement paycheck that you can absolutely count on.
Look, I know this stuff can feel overwhelming, but you really don't have to figure it out all by yourself. Here at The Annuity Expert, our advice and our services are always completely free. Give us a call at 770-755-1565, or you can visit us online at annuityexpertadvice.com to set up a free chat. We're here to help you build a retirement plan that gives you both safety and real security. Thanks so much for watching.